The United States is the richest country that has ever existed. Its currency is the world's reserve currency, sitting in central bank vaults on every continent. Its economy is worth roughly $27 trillion, more than the next three largest economies combined. And on 10 separate occasions across less than 250 years, that same country has come close enough to financial ruin that historians don't hesitate to use the word broke. Not had a rough quarter. Broke. Currency worth less than the paper it was printed on. Soldiers unpaid for months while fighting for the country's own existence. A government that, for real stretches of time, genuinely could not cover what it owed. Here's the part that should bother you a little. Every single collapse on this list followed almost the exact same script. Spend more than you have. Borrow or print to cover the difference. Convince yourself the gap will close on its own. It doesn't. Something breaks. And then, somehow, the country talks its way out of it and does the whole thing again a generation later. This is a story of 10 times the most powerful economy on Earth ran the numbers, and the numbers said no. Stick around. Because by the third one, you'll start noticing the pattern, and by the last one, you'll wonder how it hasn't happened again already. A quick note before we start counting. This isn't a list of recessions. Recessions happen constantly. They're basically the economy clearing its throat. This is a list of moments where the actual financial machinery of the United States government, the currency, the credit, the treasury itself, came close enough to failure that serious people in serious rooms had to plan for what happens next if it doesn't hold. Some of these you were taught in school, stripped of the parts that make them uncomfortable. Some of these you were probably never taught at all. All 10 actually happened, on the record, with paper trails. Let's start at the very beginning, with a country that went broke before it had finished writing its own founding documents. 1776. The currency that died before the country was officially born. The United States went bankrupt before it technically existed as a country. That's not a metaphor. That's the actual, literal starting point of American financial history. And it happened while the Declaration of Independence ink was barely dry. In 1775, the Continental Congress needed to pay for a war against the most powerful military and economic empire on the planet. It had no tax base, because it wasn't yet a sovereign government with the legal authority to tax anyone. It had no gold reserves, because 13 squabbling colonies hadn't exactly been stockpiling bullion. And it had no central bank, no credit history, and no way to borrow at reasonable terms from anyone who took the whole rebel colonies project seriously. So Congress did the one thing available to a body, with a printing press and zero other options. It printed paper money, notes called Continentals, backed by nothing except a promise. Essentially a note past the future saying, we're good for it, trust us. For about a year. This worked fine. In the exact way these things always work fine at the start, because the first printing always lands before anyone's had time to notice the trick. Then Congress kept printing, and printing again. By 1779, more than 200 million continental dollars were circulating through a wartime economy that was, if anything, shrinking under blockade and battlefield disruption, not growing to absorb all that new paper. You don't need an economics degree to know what happens when the amount of money exploding upward meets an economy standing still. You just need to watch prices. The collapse was so total, so complete, that it left a permanent scar on the English language. Not where the Continental became a standard American phrase, meaning something is worthless, laughable, not even good enough to line a drawer with. Soldiers in George Washington's own army, men literally risking musket balls for the cause, were paid in Continentals that lost value between the paymaster's tent and the local tavern. Farmers, understandably, started refusing to accept the notes at all, demanding barter or hard currency instead, which is about as clear a vote of no confidence as an economy can register. By 1781, the depreciation had gone so far that Congress essentially gave up defending the currency and let it quietly die. No dramatic announcement. No formal declaration of failure. Just a gradual, humiliating slide into worthlessness that everyone could see coming and nobody could stop. Here's the detail worth sitting with. The nation that would eventually stamp "In God We Trust" onto its money started its financial life printing a currency that nobody, God included, apparently trusted at all. 9. The 1780s, a country that couldn't even pay IT's own army to go home. Winning the Revolutionary War did not fix the money problem. If anything, it made the bill due in full, with the added complication that the people owed the money were now armed veterans standing around with nothing left to fight for except back pay. By 1783, the newly independent United States was governed under the Articles of Confederation, a system deliberately designed with a weak central government, because the founders had just spent a war fighting a strong central authority and wanted nothing to do with rebuilding one too quickly. The unintended consequence was a federal government that could politely request money from the states, but had no legal mechanism to actually compel payment. War debt owed to foreign lenders, France chief among them, sat unpaid, accumulating interest with no clear repayment plan. Veterans who'd fought the entire war were owed years of back pay that the federal government simply had no reliable way to raise or distribute. In March 1783, a group of Continental Army officers gathered at Newburgh, New York, and quietly began discussing something no fledgling republic ever once whispered about inside its own barracks: refusing to disband, or worse, a coordinated military move to force Congress's hand on payment. This is not a footnote historians invented for drama. This was a genuine, documented moment where the survival of civilian control over the American military hung on the outcome of a private meeting. George Washington personally intervened, showing up unannounced and delivering an emotional speech that, according to accounts of the room, visibly moved grown men to tears and defused the crisis on the spot. The Republic survived its very first brush with an unpaid, armed, and increasingly furious military, and it survived it because one man happened to walk into the right room at the right moment. 3 years later, the same underlying problem hit ordinary citizens directly, and this time there was no single speech to fix it. Massachusetts farmers, many of them Revolutionary War veterans themselves, were being crushed by state taxes levied specifically to pay off state war debt, alongside farm foreclosures they had no realistic way to cover. In 1786 and into early 1787, they took up arms in what became known as Shays' Rebellion, forcibly shutting down courthouses to stop foreclosure proceedings. It took a privately funded militia to put the rebellion down, because the federal government, once again, could not raise the money for one of its own. The lesson landed hard enough and publicly enough that it directly motivated the Constitutional Convention of 1787, called specifically to fix the structural weaknesses the debt crisis had exposed. The country's founding financial trauma is, in a very real and underappreciated sense, the actual reason the United States Constitution exists in its current form at all. 1837. The panic that proved a boom can just be a very convincing lie. By the mid-1830s, America looked spectacular on paper. Land speculation was booming. States were borrowing heavily for canals and railroads, and banks were printing notes far faster than they held gold and silver to back them. Andrew Jackson, who despised paper money and centralized banking, had already killed the second bank of the United States. In 1836, he issued the Specie Circular, requiring gold or silver for public land purchases, hoping to cool speculation. Instead, it exposed how little hard currency was actually sitting behind all that paper. In May 1837, banks across the country stopped honoring their own notes for gold and silver. Hundreds failed. Unemployment in major cities hit levels some historians say weren't matched again until the Great Depression. 9 states, having borrowed heavily for those infrastructure projects, defaulted on their own bonds outright, in what's now called a state debt crisis of the early 1840s. British bondholders, who trusted those states with their capital, were furious, and British satirists mocked American governments in print for it, a role reversal that would have stunned any American who lived to see the next century's lectures on fiscal responsibility. The federal government itself wasn't bankrupt in 1837. Its constituent parts absolutely were, and nobody at the state level had a Washington-style speech ready to fix it. 1861. A civil war fought with 2 armies and 2 nearly worthless currencies. When the Civil War began in 1861, both the Union and Confederacy faced the exact same fundamental problem: an enormously expensive war, and no reliable existing mechanism to pay for one. Both sides solved it the same way, and both solutions failed in almost mirror-image fashion, which is a kind of historical symmetry that would feel too neat if it weren't so thoroughly documented. The Confederacy printed money aggressively from nearly the first shot, issuing Confederate dollars backed essentially by faith in an eventual Southern victory and the assumption that cotton exports would eventually cover the difference. As that victory looked progressively less likely, especially after 1863, confidence in the currency evaporated right alongside it. By 1864, Confederate inflation had spiraled so severely that prices in parts of the South had increased somewhere between 4,000 and 9,000%, depending on the specific region and year measured. A loaf of bread that cost a few cents in 1861 could run several dollars by early 1865. When the Confederacy formally collapsed in April 1865, its currency didn't gradually devalue toward zero. It went to zero instantly and permanently, the moment the government backing it stopped existing. Southern households were left holding literal stacks of paper with no value whatsoever, worth less than the wallpaper some of them were reportedly used for afterward. The Union, with considerably more institutional credibility and an actual functioning tax base, still faced serious strain. It issued its own paper currency, famously nicknamed greenbacks, notes that were not backed by gold and were not universally accepted at full face value by merchants or foreign creditors. Greenbacks traded at a persistent discount against gold throughout the war, at some points losing well over a third of their nominal value, particularly following major Union military setbacks when confidence in eventual victory wavered. Unlike the Confederate dollar, the greenback survived the war and was eventually restored to full parity with gold years later. But for the duration of the conflict, the government fighting to preserve the Union was financing that fight with money the market itself didn't fully trust. 2 governments, 2 printing presses running at full speed, 1 currency that died completely and instantly, One that survived, badly wounded, and needed years to recover its credibility. There's a specific irony historians enjoy pointing out here, and it's worth including. The Union eventually created the National Banking Acts of 1863 and 1864 partly to stabilize its own wartime finances and build demand for those shaky greenbacks by requiring national banks to hold government bonds as backing for their own banknotes. In other words, the government facing a currency crisis solved part of it by forcing private banks to become co-signers on the government's own debt. It's a move that would be considered fairly aggressive if a modern finance minister tried it. In 1863, it was simply Tuesday. 1893, the panic that almost drained the entire United States Treasury dry. By the early 1890s, the U.S. Treasury had a specific, uncomfortably literal problem. It was running out of gold, and everyone paying attention knew it. Under the gold standard, the government was legally obligated to redeem paper currency for gold on demand, and reserves were required to stay above a certain threshold to maintain confidence. A wave of overbuilt railroads collapsing under debt, combined with agricultural overproduction, triggered the Panic of 1893, one of the worst depressions in American history to that point. Unemployment soared past 10% nationally, higher still in industrial regions gutted by factory and railroad failures. People did the rational thing and started redeeming paper dollars for gold as fast as they could, draining the Treasury at an alarming rate. By early 1895, reserves had fallen dangerously close to zero, threatening the government's ability to maintain the gold standard at all. The fix came from a source that should feel uncomfortable to anyone who thinks government finance should stay separate from private banking. J.P. Morgan personally organized a syndicate of private bankers to loan the U.S. government gold directly, bailing out the federal treasury with private capital, in exchange for a healthy profit on the bonds issued to secure the deal. A private bankers consortium propping up the solvency of the United States government doesn't get nearly enough attention in the standard retelling, and it is, without exaggeration, exactly what happened. The government then turned around, once it had accumulated a substantial share of the nation's gold, and revalued gold significantly higher, effectively devaluing the dollar overnight and pocketing a considerable profit on the very gold it had just legally compelled its own citizens to hand over. It worked, in the narrow technical sense that it helped stabilize the banking system and gave Roosevelt considerably more monetary flexibility to fight the ongoing depression. Forward to 1971, the day America broke its own promise. For decades after World War II, the U.S. dollar was the anchor of the global financial system. Under Bretton Woods, foreign governments could exchange their dollars for American gold at $35 an ounce. But by the late 1960s, America had created far more dollars than its gold reserves could support. Vietnam and massive domestic spending had driven deficit higher, while countries like France began converting their dollars into gold, draining America's reserves. Then, on August 15, 1971, President Richard Nixon went on television and announced that the United States would immediately stop converting dollars into gold. The Nixon shock ended the Bretton Woods system and transformed the global economy. America hadn't literally run out of money. It had run out of enough gold to keep a promise it had made to the world. So it solved the problem by ending the promise. 1979, when America had to crash its own economy. By the late 1970s, America was trapped in stagflation, high unemployment and inflation happening at the same time. Inflation reached nearly 15% in 1980. Then, in 1979, Federal Reserve Chairman Paul Volcker took drastic action. He pushed interest rates above 19%, deliberately triggering a severe recession to crush inflation. Unemployment climbed above 10%. Farmers protested. Home builders protested. The economy was hurting badly, but it worked. Inflation eventually collapsed, and confidence in the dollar returned. The Federal Reserve had essentially chosen to break the economy in the short term to protect it in the long term. To 2008, when the banks went broke. By 2008, America's financial system was sitting on an enormous mountain of mortgage debt. Banks had packaged risky mortgages into complex securities and sold them around the world as if they were safe. Then the housing market collapsed. In September, Lehman Brothers, a 158-year-old investment bank, became the largest corporate bankruptcy in American history. The crisis spread rapidly. Congress approved a $700 billion emergency bailout. AIG received an $85 billion rescue loan. General Motors and Chrysler also required federal assistance. Unemployment climbed above 10%, while trillions of dollars in household wealth disappeared. America didn't officially go bankrupt. Instead, the government spent hundreds of billions to prevent the financial system from taking the entire economy down with it. 2011, America lost its perfect credit rating. For decades, U.S. government debt had carried the highest possible credit rating, AAA. Then, in August 2011, that changed. And the shocking part was that America wasn't downgraded because it couldn't pay its debts. It was downgraded because Congress was fighting over whether to raise the debt ceiling. The debt ceiling was simply the legal limit on how much the government could borrow to pay obligations it had already made. Congress eventually raised it, but the damage was already done. On August 5, 2011, Standard & Poor's downgraded U.S. debt from AAA to AA+, citing political dysfunction as a major factor. The world's most powerful economy hadn't been downgraded because it was broke. It had been downgraded because its own government had made the world wonder whether it would pay its bills on time. The pattern. Look at all 10 crises, and the pattern becomes hard to ignore. Spend more than you can reliably cover. Borrow or create money to fill the gap. Let the gap grow. Eventually, something breaks. Then someone has to clean up the damage. The United States has never formally defaulted on its sovereign debt in the fullest modern sense, but it has repeatedly come close enough to show just how fragile financial confidence can become. And that may be the most important lesson. Financial systems rarely collapse because of one bad decision. They collapse after years of decisions that seem manageable until suddenly they aren't. History doesn't repeat on a schedule, but it keeps leaving the door unlocked. If you enjoyed this video, subscribe for more deep dives into the financial history nobody teaches in school, and comment which empires collapse you want covered next.